This month, Life Insurance Strategies Group is in Abu Dhabi, and specifically we're at the Louvre, and behind me in the picture is the new Guggenheim that's being built, and it's going to be a much larger Guggenheim than even the one in Spain. It'll be the largest in the world. Now here in Abu Dhabi, we're thinking a lot about pre-immigration, so pre-immigration into the United States. And when that happens, we see a lot of wealthy foreign nationals make use of life insurance to help with their tax situation. Now this is a typical situation of how this might work. So ahead of becoming a U.S. person or even having U.S. beneficiaries, a foreign person might be a grantor to a trust, an irrevocable trust. That could be a trust in the United States, it could be a trust in an offshore jurisdiction, a place like BVI or Guernsey, and they'll place a lot of assets in those trusts for the benefit of future U.S. beneficiaries. So there might not be a U.S. beneficiary yet, but eventually there will be. Now, let's go down the road a little bit. We've got money in this trust. Well, something that the U.S. tax code does is if you have U.S. beneficiaries and you have a foreign grantor trust, when that foreign grantor dies, it becomes a non-grantor trust. And we have to tax income in that trust if it's not distributed. And if it's distributed, it's taxed. So one way to deal with this problem is inside of that trust is to put some of that money in life insurance. Now this could be retail products like whole life, index universal life, VUL, etc. Or it might be private placement life insurance. So what happens obviously in life insurance is all that money is in the life insurance policy, it's growing tax deferred, so it's not throwing off any taxable income, and it's staying in that until it's one day needed, either in the form of death benefit or as to be distributed to those U.S. beneficiaries. So what this transaction does is it buys time. So you're not having to pay tax on undistributable net income inside of that foreign non-grantor trust. Now we do see a lot of people that are funding these trusts that will become U.S. persons. And of course, what you want to do before you become a U.S. person, as we talked about before, is get as much money and assets out of your future taxable estate today than when you become a U.S. person. So obviously, if you're not a U.S. person, you can make all kinds of gifts to that irrevocable trust. They're not taxable. But now, let's talk about when you become a U.S. person, you get that green card or you get that passport, you become tax citizen just like anybody else in the U.S. And so again, what's kind of nice is if you've built up money inside of life insurance policies, you're not facing taxation on that growth in those trusts. One specific product that's very popular for this accumulation is frozen cash value. That's a form of private placement that violates Section 7702A, but is compliant with Section 7702G. Now let me tell you what that means. It means that if there is growth in the premiums in this policy, so if you put in $1 and that $1 grows to $2, you're taxed on that because the cash value is not tax compliant. However, you're not taxed on the death benefit. So what do? You freeze that $1 you put in, and any growth of that dollar is just added to the tax-free death benefit. So this is a fantastic way with just a little bit of death benefit, 5% usually, that you can put a lot of money into a private placement life insurance contract inside of a trust. So if you're planning to move to the U.S., having money inside of an irrevocable trust that is then inside of a frozen cash value is very optimal for your tax efficiency. Remember, at Life Insurance Strategies Group, we don't sell products, but we help our affluent individual and institutional clients make decisions involving complex life insurance transactions. If we can be of help to you, reach out to us at lifeinsurancestrategiesgroup.com.